One of the most common questions we hear is, what's the difference between a soft pull and a hard pull? Here's the key point. A soft pull and a hard pull can show the exact same credit score if the same credit bureau is used and the same scoring model is used. The inquiry type does not change the score itself. The score is determined by the bureau data and the scoring model, not whether the inquiry is soft or hard. Do soft pulls include the same data? Yes. A soft pull report includes the same credit data and information as a hard pull. Same trade lines, same public records, same score. The difference is how the inquiry is recorded, not the credit information returned. When people talk about a credit score, they usually think it's just one number. But in reality, there are multiple scoring models, and ultimately, soft pull solutions can get you access to any scoring model with each of the 3 credit bureaus. FICO versus VantageScore. What's the difference? FICO scores are still the most widely used for lender underwriting, especially in traditional lending. VantageScore 3 and VantageScore 4 models were developed more recently by the credit bureaus themselves to score more consumers using fewer barriers. They offer strong coverage for thin or newer credit files, are common in tenant screening, fintech, and pre-qualification workflows, and VantageScore 4.0 adds trended credit data and alternative insights. This allows businesses to gain meaningful credit insight without always pulling all 3 bureaus up front. The key distinctions. FICO is the most common for final underwriting. VantageScore has efficient insight, often using a single bureau while reflecting broader consumer behavior. FICO 8 is the most widely used credit score across general lending. It is common for credit cards, personal loans, and many auto lenders. Has less impact from small dollar collections. It's more forgiving of isolated late payments, and it's still sensitive to high utilization. This is often the baseline score businesses see when pulling consumer credit. Choosing the right scoring model. There is no single best credit scoring model. The right model depends on your industry, your workflow, and your lender requirements. If you are not a lender, the best practice is to use the same bureau and scoring model your lender uses. Many industries use specialized credit scoring models. Auto lenders use auto-specific FICO scores. Mortgage lenders use mortgage-specific FICO scores, and credit card companies use bank card-focused scoring models. These models are designed to predict risk for a specific loan type, not general credit behavior. In the mortgage industry, most lenders are still required to use older FICO models. Experian uses FICO Score 2, TransUnion uses FICO Score 4, and Equifax uses FICO Score 5. These are often called classic or mortgage FICO scores. They have a heavy emphasis on payment history, are less forgiving of collections, and are conservative by design. These models are still deeply embedded in mortgage underwriting requirements. In the auto industry, lenders typically use FICO auto scores. The most common today are FICO Auto Score 8 and FICO Auto Score 9. FICO Auto Scores 2 through 5 are less common. Some dealers and lenders also use VantageScore, especially when pulling a single bureau to manage costs. Newer FICO models reflect more modern credit behavior. FICO 9 is more forgiving of paid and medical collections. FICO 10 and 10T use trended data to analyze balance movement over time. Both have greater emphasis on recent payment patterns. These models are especially useful for identifying improving or emerging risk. Soft pull solutions can set clients up with any required credit bureau and scoring model.